Hello, this is Andrew Westhof. I'm a loan officer in Ann Arbor, Michigan. And today I'm going to talk to you about the difference between FHA and conventional loans and which one is going to make the most sense for you. I want to start off by saying that I am a very knowledgeable loan officer, but I'm a very novice YouTuber. So I apologize in advance for the quality of this video, but I hope the content is good and is helpful to answer your questions. So in general, first to kind of get started on this, conventional is a superior loan product in almost all cases to FHA if you're a well-qualified borrower. So where FHA starts to make sense, and you'll see here shortly, is when you have a little bit lower credit score, some issues in the past like foreclosures, short sales, bankruptcies, things like that, or just need to qualify for more loan. So compared apples to apples, conventional is the better of the two, but FHA is not a bad loan program, and don't think that you're going to have far less ideal loan terms because you have to go FHA. If you have to, FHA is fine. Conventional is just better. So first, FHA allows 3.5% down, and conventional allows 3% down for first-time home buyers or for its Home Ready with Fannie Mae or Home Possible with Freddie Mac. So they both can do a very similar down payment, very low down payment. Just to alleviate some common misconceptions, FHA is not a first-time home buyer program. You can have bought many, many homes before. There's no wait period from when you've purchased your last home to do an FHA loan. The only real issue is if you've purchased a home with an FHA loan before and you still own that home and still have that FHA mortgage, it can be very difficult to buy another home with another FHA mortgage. So both programs, if you are putting less than 20% down, you're going to have a monthly mortgage insurance. FHA has a standardized monthly mortgage insurance, which means it's the same for everybody. It doesn't matter how well qualified you are, it's the same amount. For conventional, they have what's called PMI, which stands for private mortgage insurance. And private mortgage insurance means that private companies issue the insurance for the lender, and they are making the decision on how much to charge you based on your risk factor. And the main risk factors that they're considering are what's your credit score and how much down payment are you putting. The higher your credit score and the more you're putting down, the lower your monthly PMI is. Now on conventional, you can put 20% down and you don't have PMI at all. On FHA, that's not the case, and we'll go into a little more detail on that. But most folks are doing 3.5% down on their FHA loan. Just so you know, you may not understand mortgage insurance, just very briefly. Mortgage insurance and PMI, they're essentially the same thing. What they do is they protect the lender in case you default on the loan. So it's not an insurance, that's not anything that helps you to have it. It only helps the lender, but it mitigates risk. So it does help you in the sense that you can buy a home without putting 20% down, but you pay a little bit more per month because of that. But in most cases, it's not a crazy amount of money. So FHA, one of the things that one of the reasons that I said it's a worse loan program in general than conventional is they charge an upfront mortgage insurance premium of 1.75% of the loan amount. So if you are getting a loan for just an example of $200,000, that's $3,500 that is going to be tacked onto your mortgage. So your monthly payment will be higher because your loan amount will be higher, and it's just money you're paying upfront to basically mitigate risk for FHA. So that money goes into a pool of all the other folks that have FHA loans, along with the monthly mortgage insurance. And that way, folks that default on their loan, FHA dips into that pool of money to cover their costs and their expenses for foreclosures and things like that. So 1.75% is quite a hefty amount. It's a decent amount to take out of your equity from day one. So that's really one of the main reasons that I don't love FHA. But there are some other things as well. And there are some areas where FHA is better than conventional too. And we'll see those here shortly. Here's one. On FHA, you can go up to 57% on your debt to income ratio, which is just your total debt that we use for the qualifying calculation divided by your total gross monthly income. On conventional, it's 50%. It's also harder to get to that 50% on conventional. Neither the 57% for FHA or the 50% on conventional are guaranteed for any borrower. We have to go through what's called an automated underwriting system to verify that you'll qualify for that debt to income ratio. But most folks on FHA can go up to 57% or very close to it. On conventional, it's not. It's common that someone might only be able to get up to like a 45% debt to income ratio. So if you need to qualify for more home with your current income and debts, FHA might be the way to go because of that higher ratio. FHA allows much shorter wait periods on a lot of things like bankruptcies, foreclosures, short sales, basically derogatory credit in the past, where conventional has longer wait periods. So you may have to go FHA if you've had derogatory credit issue in the past. FHA is tougher on the appraisal, not significantly. A lot of listing agents will make a bigger deal of it than it is. They're basically going to scrutinize some things that are not as big of a deal, like chipped or peeling paint, missing covers on outlets, missing handrail on the stairways. You may have to do a water test if you're on well water, things like that. So it's nothing that's terrible, but what ends up happening is if something gets flagged in the FHA appraisal, those things have to be addressed before the loan can close. So if there's some chipped or peeling paint, FHA is going to make you, they're going to make the seller basically paint where that chipped or peeling paint is, and have the appraiser come back out to view it before the loan can close. So this becomes an issue because, one, most sellers don't want to do repairs, even if they're smaller repairs. It's going to take more time because the repair has to be done. Then the appraiser has to go back out, and it will cost you, the buyer, a little bit more money because you're going to pay. In my market, it's usually $100 to $200 for the appraiser to come back out just to snap pictures and say, yep, the work that I said needed to be done has been completed. It's tougher to get an offer accepted with FHA. So the reason for that is a couple things. One is what we just talked about, the appraisal. Another is that most listing agents know that if you could choose to go conventional or FHA, if you're very well qualified, you're almost always going to go conventional. So they're concerned a bit with your qualifications. If you're making an offer on a home and you're the only offer, it doesn't really matter if you're FHA or conventional. If you're in a multiple offer situation, that's where it can matter, to the point where in very competitive markets right now, a lot of times it doesn't even make sense to make offers and look at homes if you're FHA. So talk to your realtor about that and see if that's going to be a concern. Because of this, there are situations where some buyers that it does make more sense to go FHA because maybe they have a lower credit score and the finances do actually look better on FHA, will go conventional because otherwise their offer might not get accepted. And then FHA tends to have a little bit longer of a loan process. A lot of the reason for that doesn't have anything to do with the program. It has to do with the availability of underwriters. So underwriters for FHA have to get what's called a direct endorsement from HUD. So they have to go through some additional steps. It's expensive for the lenders that are employing these underwriters to have them go through those steps. So there's less underwriters that go through those steps to become an FHA approved underwriter. A lot of times in normal markets, it's not that big of a deal. Lenders plan for it. So the turn times could be pretty darn close to the same. But when things get really busy, they can't just turn around and all of a sudden hire more FHA lenders, FHA underwriters rather, because they have to go through that direct endorsement process, and it's time consuming. They have to have a certain amount of experience, things like that. So long story short is there's just less people doing those doing those underwrites. So it can be an issue. But in my market with my lenders, usually 30 days for either program is going to be fine. But certainly talk to your lender to make sure. And then also because the appraiser is similar to the underwriter, they have to be approved to do FHA appraisals. There can be a little bit longer of a turn time on getting the appraisal completed. So I'm going to give you guys some examples, and this will probably make some of what I've just talked about a bit more clear. So all of these are going to be $250,000 purchase prices with 3.5% down. We know that we can go less down than that with conventional, but just to kind of keep things apples to apples. So with a 640 credit score, and I know it says it here, but just to put it out there as like a disclosure, this is not an offer of credit. These are real numbers that I ran yesterday, so on December 22nd, with real rates from a real lender. However, this is not an offer of credit or terms for a loan and advertisement in any way. This is just for an example, and this just tends to follow the same trend. Interest rates change every single day, so they could certainly be different. Back in when I first got in the industry in like 2012, FHA actually looked a lot better than conventional because the rate was so much lower. So certainly check and have your lender run numbers both ways if you're concerned. But as it sits right now, this is how it tends to work for FHA versus conventional. I'm going to show you guys 3 examples here. So FHA, sorry, went too fast, has an upfront mortgage insurance premium, like I said, of 1.75%. So on a $250,000 purchase, that's going to be $4,221. So pretty significant of a $4,221 loss in equity from day one of your loan. And again, that's the main reason that I don't love FHA. Interest rates are pretty good. So even with a 640 credit score, you can get a rate pretty in the very low 3s. So 3.060% at par, meaning there's no points associated with that rate. Monthly mortgage insurance is set, so it doesn't matter that this person's credit score is 640. Their monthly mortgage insurance is $169.24. So the total of the principal and interest plus the mortgage insurance is $1,212.12 per month for a 640 credit score. On conventional, there's no upfront mortgage insurance premium. The interest rate with a 640 credit score for the lender that I was looking at was 3.875%, and that was actually the highest interest rate they offered yesterday. And to get that rate, it was not at par. So there were points that had to be paid, 0.467. So basically 0.5% of the loan amount, or $1,126.64 added to their closing costs. And then that ended that got them to an $1,134.45 principal and interest payment. Monthly private mortgage insurance was $241.25, so significantly more than FHA there, and a higher interest rate. So that payment with principal, interest, and private mortgage insurance is $1,375. So quite a bit more than the FHA option for a 640 credit score. So it's a no-brainer that this person would be going FHA unless they needed to go conventional to get their offer accepted, because the sellers weren't accepting FHA offers. So now let's look at a 700 credit score. So again, upfront mortgage insurance premium is the same with FHA. Interest rate was slightly better, 2.927%, so under 3. This is what I hear a lot of people brag about, is I got a 3% interest rate, a 2.927% interest rate, a 2.875 with FHA, and they think that they did really well. Monthly mortgage insurance is the same, $169.24. Principal and interest plus mortgage is $1,194.52, so slightly less than the previous example with a little bit higher credit score. And then again, conventional is not going to have that $4,221 upfront mortgage insurance premium. The interest rate is 3.388% at par, so now there's no points associated with this. Still a little bit higher interest rate than FHA, but on the mortgage insurance, it's $114.59. So quite a bit lower on the mortgage insurance. When we shake everything out, principal plus interest plus PMI, it's $1,182.88 versus $1,194.52. So on the surface, you go, well, the payments are pretty darn close to the same, $12 difference. I guess conventional would make the most sense, so we'd go conventional. However, it actually is significantly better to go conventional for this borrower, because they're not getting that $4,221 up front just kind of sucked out of their equity. They're also that $114.59 a month PMI that they're paying. On conventional, that's removable as soon as they get to 20% equity based on their purchase price or their appraisal, whichever is lower. So on FHA, the mortgage insurance is going to stay on there for the life of the loan. If you put less than 10% down, you're going to have mortgage insurance for the life of the loan with FHA. And I'll talk about that in a little bit more detail here momentarily. But last example, probably already know kind of how this is going to go, but 760 credit score. So I'm going to go really fast on FHA because literally everything is the same from the previous slide. The interest rate still 2.927. Mortgage insurance monthly is set $169.24. Principal plus interest plus mortgage insurance, 1194.52. And then I skipped that first bullet, but we already know the upfront mortgage insurance premium is the same, 4,221. So again, no monthly mortgage insurance premium. The interest rate's the same for this credit score because the down payment's pretty low, but 3.388%. So again, interest rate's a little bit higher on conventional, but monthly private mortgage insurance is only $60.31 for this borrower. So significantly lower. And then the total principal plus interest plus private mortgage insurance is $1128.60. So they're saving almost $66, a little over $66 a month, or a little less than $66 a month. So again, no brainer for them to go conventional versus FHA. And what I find typically is once you're above 680, it's usually going to make more sense to go conventional than FHA. That's kind of the break even that I see. 660 to 680 is kind of sometimes a little bit of a gray area. But when you get a little bit lower on the credit score, that's when you kind of have to go FHA. And the nice thing about it is FHA exists and you can still get a great interest rate. The monthly mortgage insurance is affordable, so you can get in a home and you don't have terrible terms. So just a little snippet on the upfront mortgage insurance premium. So again, it's 1.75% of the loan amount. And then the monthly mortgage insurance on the loan is for the life of the loan unless you put 10% down. And if you put 10% down, it still stays on there for at least 11 years. So one thing I hear constantly from my buyers is that if they're going FHA, their plan is to refinance to get out of the mortgage insurance. And usually they want to do that pretty early, which is a great goal if they're planning on paying the mortgage down to get 20% equity and refinance to get the mortgage insurance removed. One thing you always have to consider though is that the mortgage insurance is going to the interest rate and the terms of your loan are set when you lock your loan in, and the mortgage insurance is obviously on there, and it's a good idea to try to get it off of there. But if interest rates increase, it might not make sense to refinance to remove mortgage insurance because you might end up paying a lower payment overall with the mortgage insurance than a higher interest rate without it. So what I mean is right now interest rates are in the low 3s, and I'll show you this. This is a little chart on how mortgage insurance works for FHA. So if we're putting down right here, less than 95%, the mortgage insurance premium of 85 basis points, or basically that's 0.85%. So it's basically adding 0.85% to your loan. So just to kind of put it in context, if you're getting a rate in the low 3s, now you're at 3.85 or roughly 3.85. So if interest rates in the market, which the market fluctuates every day, interest rates go up and down every single day. If a year from now interest rates go to 4, which they probably won't, but they could, then your low 3% rate is going to be better even with the 85 basis point mortgage insurance premium. So the whole point of me saying all of this is that when you buy the home, plan on, do your budget with the mortgage insurance in there so you know that you can afford the mortgage payment even if you're not refinancing down the road to try to remove it. And I'll send a link for this chart. So it just kind of shows you the mortgage insurance rate with different down payment amounts and if it can be removed. And you'll see on here that most of the time it's on there for the life of the loan. If you put 10% or more down, it's on there for at least 11 years. So moral of the story here is that both FHA and conventional are good mortgage programs. Conventional is better if you have good credit, so it's good reason to set a goal of trying to get the credit score in that 680 plus range because it's going to be easier for you to get your offer accepted and you're going to ultimately have better loan terms. But that's the gist of it. If you do have any questions, please leave comments. I'll try my best to reply to them, and I'll leave some contact information if you'd like to reach out to me. Hope this was helpful, and please subscribe. I'm planning on making some additional videos in the future that can hopefully help buyers, first-time home buyers, and just buyers in general as they're thinking about purchasing a first home. Thank you.